All done. All silent. Going. Gone. So congratulations.
Welcome to the Current Market Insights podcast, brought to you by Harris Partners Real Estate. Each episode, we chat with real estate author and industry leader Peter O'Malley to discuss the current property market conditions and provide insights to assist you on your property journey.
Welcome to another episode of Current Market Insights. Peter O'Malley. It's been a little while. Welcome back.
Great to see you, Kieran.
Great to see you as well, my friend. Look, at the time of recording, Peter, the RBA has made what I guess many would consider a generous decision this month to put the rates on hold for a second month in a row. I wonder, what are your thoughts on what the motivation might be for the pause? Because I certainly did a lot of reading in the last couple of weeks, and indications were that we should probably expect another rise and to prepare for that. But obviously Philip Lowe and the other board members have decided against that.
Yeah, I think by the time the decision day came around, market consensus was leaning towards the RBA holding. That's probably as a result of numerous economic indicators starting to show the impact of higher interest rates and inflation pulling back. What's interesting is the US increased their interest rates at the last meeting that the Federal Reserve had there on a lower inflation reading than Australia has. So as we know here in Australia, the RBA has come under enormous pressure, and there will be some people that will question the wisdom of holding 2 months in a row and potentially seeing consumer spending and inflation edging up again as people mistakenly or hopefully believe that the rate cycle has peaked. But it is interesting times, and the RBA statement coming after the pause this week suggested that the RBA are going to take a while before making their next move.
So I've certainly spoken to a few people who, I guess, postulated that a pause might indicate that we had tamed inflation to a certain extent. What you've just said certainly indicates that you don't necessarily believe that. Is it any indicator that a second pause might be their way of saying, look, we think we've got it pretty much under control now, let's hold, and then our next move that we see as a society might actually be downwards?
No, there's nothing in their dialogue that suggests they feel like they've won the inflation battle. If you think about people on fixed income and those that maximise their debt, whether it be through a home purchase or refinancing during COVID when interest rates were running at around 2%, they've seen their mortgage rate nearly triple, certainly double, nearly triple. So I think the RBA are giving the economy and those households the benefit of the doubt by sitting back and saying there will be a delayed impact from everything that we've done to date, and we mustn't be too hasty in increasing interest rates from this point on, because the message they have sent out of this more than anything is they're not here to smash the economy, they're here to manage the economy. And if they did increase interest rates in August, that would suggest that they were here to break the economy come what may. Whereas this is now they're trying to engineer a soft landing. There will still be people that unfortunately go to the wall from this, but understandably and rightfully so, the RBA are trying to minimise people that go to the wall and bring inflation down to their target of 2 to 3% in an orderly fashion. Only time will tell whether they should have increased interest rates in August and whether they were right to take a longer look at things. There's a lot of people on both sides of the fence saying they should have or they shouldn't have increased the rates, but we've got the decision that we have, and we'll look at it all again in September.
Absolutely. I certainly feel a little bit buoyed by a pause. Someone who's seen their mortgage increase substantially. I certainly welcome every pause and potentially downward movement. Do you think that the decision to pause has anything to do with there was a report, I think, last week or the week before talking about consumer confidence across the market in all sectors is incredibly low. Do you think that, the RBA is trying to just rebuild a bit of confidence and say, hey, look, it's okay. We're not going to be too bad. We should get through this collectively if we all just kind of take a deep breath and make measured decisions moving forward?
If you read their statement and interpret what they're trying to tell us in there, it's that the full impact of the decisions, the rate decisions they've made to this point, have not been fully felt by the market and the economy. And until they see more impact flow through to the economy and the market at large, they won't know what their next move is, whether that's further pause, increasing again because inflation is proving stickier, or things are suddenly deflationary and they feel the need to throw a cut in the future to stimulate things. So at the moment, the smartest and safest measure for the RBA, given all of the heavy lifting they did early in this inflation cycle, was to keep things on hold.
What we're particularly interested in, I guess, Peter, is the impact of RBA decisions on the property market. That's our focus here. With recent data showing that, in the last quarter, Sydney properties averaged a growth rate of a bit over 5%, give or take, depending on which reporting house you kind of get your data from. What do you think is driving this continued strong result? I know we talked about certain sectors in the past that have had, a greater influence or a lesser influence, but I wonder, on the ground, are you seeing any particular evidence of one section or one part of the consumer psyche that's driving this price rise?
Well, I think across the country, all real estate agents have reported really low stock levels as vendors, consumers sort of bunkered down and were looking to ride this cycle through. And because market sentiment was so negative, vendors were saying to real estate agents, given the sentiment of the day, there's no way I'm selling my property when the market's running on these metrics. I'll stay on the sidelines and come out to play when things improve. My personal situation, respectively, for example, is that interest rates are not impacting my lifestyle, so therefore I'm not putting my property on the market at a time where sentiment's down. That's been vendor psychology, broadly speaking, out there. The ensuing lack of stock from vendors feeling that way, or prospective vendors refusing to come to the market, meant that the buyers that were active in the market, whilst there may have been less of them, they had a lot less properties to compete for. So it does show you that the fluctuations in interest rates are not the sole determinant of how a property market will perform in the short term, whereas this particular cycle that we're in now, it's all about supply and demand, and monetary policy of the day is not the overriding element for home buyers and sellers.
So given that we've got low supply and relatively high demand at the moment, how would this sales cycle or this sales period compare to something like, say, the boom of 2021, where you just had buyer frenzy on the ground constantly? Sellers could literally list their house and by the time they pushed the bins out, they had an offer on the table. How do you compare, I guess, the sales experience in the two markets, given that really there's similar elements at play, but in completely different economic environments?
Well, I think the big difference with 2021 is in 2021, everything was selling, and it was selling in a frenzied fashion. Come to this year, there's a real flight to quality, and the market is overpricing or overinvesting in niche elements of the market, and then there are other aspects of the property market that are unloved. So without wanting to beat up on anyone, high-rise apartments with special levies and strata issues are some of the most unloved product in the market at the moment. The further you get from the CBD with those high-rise apartments, the less appeal that those properties have to the buyers in the market. Properties that need substantial renovation, unrenovated, unloved, unlivable, they're not doing so well at the market in the market at the moment, given the cost of renovating and or rebuilding. The problem of getting a DA through council, if that's what's required with the property, is lengthy, and people don't want that holding cost sitting on their balance sheet as council take 12 to 18 months in some instances, postulating whether they'll go ahead with and approve the DA or not. The things that are in high demand are well-located apartment buildings without issues, renovated houses with high quality finishes. The top end of the market, as we've seen, has continued to perform very well. Trophy homes around Sydney are outperforming. I saw a result during the week where a house in Bronte sold for $4 million more than what the owner paid for it 15 months earlier.
Yeah, it's unbelievable.
So there's some serious money at the top end floating around Sydney. What's coming through, and I'm glad it's coming through in the commentary now, Kieran, is the amount of Chinese money that's hit the country. As real estate agents, we were seeing it on the ground at open inspections from the start of the year. But now that the sales have occurred and settlements have gone through, the media are talking about the amount of Australian real estate being absorbed by offshore buying. And that's been another supporting element in the market that's been largely overlooked because everyone is focused on low stock levels as being nearly the sole reason as to why the market performs so well.
Yeah, I feel like too it's a potential indicator that the national kind of focus on COVID and the restrictions around that may have eased, more generally across the board. I mean, there's still some reporting about it, but I feel like it was, big talk about Chinese and foreign money pre-COVID, and then nothing. And now we're certainly seeing it again on the ground, and it is, in my experience as well, having an impact on prices on the street.
Yeah, I would say the buying from Chinese buyers has got more to do with what's gone on in China once their lockdown was over. President Xi got his third term, and he sent the message that China was open for business and looking to do business again globally. And at the same time that I was, like everyone else, seeing that rhetoric through the media, then suddenly we were noticing it on the ground. So I think the return of Chinese buyers to the Sydney and Melbourne market has got as much to do with what decisions have been made in Beijing as anywhere else.
Yeah, it makes sense. I read a report just this week from CoreLogic talking about just new listings across the market that they're seeing in Sydney. And they suggested that the vast majority of new listings are disproportionately investor-owned. Now, I wonder, is this an indicator, do you think, of the mortgage cliff that we've talked about in the past and investors reaching a point where they just need to free up capital? Or is there some other motivator, related to some other element that is driving this behaviour?
Without a shadow of a doubt, Kieran, it's driven by the mortgage cliff. So there was a mistaken view in hindsight that interest rates would go up and people would sell their family home. And the way the market's played en masse at the moment is mortgages have gone up. And people have said, well, I'm not selling my family home, but I need to get debt levels down. I've got some good equity in the investment property. It's time for it to go. So there's been a disproportionate amount of two things in the market at the moment that CoreLogic have pointed out quite wisely. The first is the number of people that purchased in 2021 and have resold for a loss in 2023. So whilst the Sydney market is up a phenomenal 6.5%, for the year, we must keep in mind that that's making back half of the loss that it occurred in 2022. And people that can't fend off mortgage rates who purchased in 2021 are actually selling for a capital loss. And that's a disproportionate amount of people selling out at a loss than what CoreLogic are used to seeing on their numbers. And then the other point that you've just quite correctly made there is that there's a higher percentage of investors bailing here to put the equity from their investment property against their family home.
So these investors that are selling out, do you think that they're, I would make the assumption, or I'd, maybe make the link that those properties are not being snapped up by other investors, given the scenario we're in the market at the moment. Do you think that these investors selling out is having a positive impact on the rental market and the potential reduction in, rental demand, or, freeing up properties for people to own or occupy and I guess relieve a bit of that stress?
We're definitely seeing investors who sell out. There's an 80% chance they'll sell it to an owner-occupier. There's very few to essentially no new investors coming into the market. Any property that we sell that goes back to the rental market does so on a short-term basis. The people might be living overseas. They may be planning to do a renovation, and until they do that renovation, they're happy for the tenant to stay there for another 6 or 12 months, for example. But the vast majority of landlords that sell out sell to an owner-occupier that moves in. So over time, if that trend continues in that direction, which I have no reason to believe it won't, that will shrink the rental pool. And as the next wave of international students come into the capital cities in the new year, you will see all of the headlines and all of the queues at rental open houses that we saw at the beginning of this year.
So does that make this period right now the best time to snap up a rental if you are looking for one?
Yeah, it is actually, because winter is actually a very soft period in the rental market due to too many listings. Every year, the rental market in winter underperforms. Every year during winter, the sales market actually overperforms. So if I'm a tenant, I'm actually trying to get a good property for the next 18 months to 2 years now, while the rental market's been in a bit of a lull. Because if you ask me, whilst the media are freely using the phrase rental crisis, I don't believe the rental crisis has even started yet. I accept a rental crisis is coming, but there is not a rental crisis yet. There's insufficient building. There's no cohesion amongst the three levels of government to get new stock to market, and they're flooding the country with hundreds of thousands of people each year with essentially no housing for them to live in, no additional housing for them to live in. So in 2024, 2025 is when you'll really see a rental crisis.
In my opinion, the sad reality of the government dysfunction around this issue is that in the amount of time they've spent arguing about policy, they could actually have built some houses for people to live in and help ease some of the tension. Look,
they all agree on the problem, but they can't agree on the solution.
Look, no one wants to give credit to anyone else. That's always the issue in Australian politics. Look, as we sort of head towards the close today, Peter, I want to get your thoughts on, given the RBA's decision today, given how inflation's been trending, relatively stable or even potentially, receding slightly, but also given the movements of the US Fed and the US economy, where do you see the property market sort of moving in the next few months? Obviously, I'm not going to hold you to your predictions, but do you think that we're going to continue with strong price growth and continued demand, or, are we going to hit another bit of a shock as we, more people come off fixed mortgages moving toward the end of the year?
In July, Kieran, we saw at Harris Partners, we saw our highest listing month since the beginning of COVID. So that's the highest listing month since April 2020. And if that trend continues in our office and it continues in every other real estate office around the country, by the time you get to the middle of spring, the market could potentially be oversupplied with listings as people take the brunt of the mortgage cliff, and it does change their scenario. So I think it's a wait and see, but we're by no means out of the woods on this yet. And the inflation battle is not won. Thankfully, unemployment is really low, but the true and full effects of the mortgage cliff are only impacting people right now. And people jumped, I guess because of the word, the common vernacular is mortgage cliff. So everyone assumed that as soon as we hit the cliff, there'd be a sharp
an
immediate impact on the property market. But the reality is the mortgage cliff meant people's mortgages was going to go up and has gone up overnight. Different people will adjust to that immediately or be able to see it off for some period of time. So the impact is going to take 6 to 9 months to fully occur. So where are we in the middle of spring? Where are we at Christmas time? Where are we at Easter time? They're sort of markers in time that I think you'll find people who are experiencing a mortgage that has tripled over time, that they will find that very tiring, and that may weigh on them.
Yeah, of course. I just before we wrap up, very quickly, given that property prices and demand has in some ways helped keep inflation stable or keep it rising, would it not then make sense, if we do end up with an oversupply scenario moving into spring, that may contribute to a reduction in inflation and effectively bring, the crisis, for lack of a better term, back slightly and make it a little bit easier for people?
I don't know if lower house prices will have a short-term impact on the inflation reading, because a lot of the inflation is sort of imported from international factors. But I know the RBA would not be unhappy if the property market levelled out from here. And I've read many reports that they're as bemused and confused as anyone that property prices have risen through this rate cycle. But, we can all have a prediction about what a market's going to do, but a market's a fluid beast and it'll do what it does.
Absolutely. Well, much like the RBA as we move through August, Peter, it's a case of wait and see for us here in the property market.
Yeah, look, we've had some sales in the last week where there's 5-6 contract bids on them. So the whole supply-demand imbalance is very much there at the moment, and it's a great opportunity for vendors to take advantage of if they've got concerns about what the economy and the market may look like in 2024.
Makes sense. The only thing we know for sure is what we know right now. Look, I'm going to wrap it up there for today, Peter. As always, thanks for joining me on the podcast, and I'll talk to you next week.
Thanks, Kieran.
Thanks for joining us on the Current Market Insights podcast, brought to you by Harris Partners Real Estate, the podcast providing real estate insights you won't find anywhere else.